Okay, so this is November 2025, and this presentation is done by me on an Indian Society of Anesthetists Tanjavur branch monthly meeting. So, ISA monthly meet. So, the topic is financial independence, an anesthetist to anesthetist, a doctor to doctor perspective. Okay, so I am talking about financial independence for doctors. So, I hope that it's useful particularly for youngsters so who have just entered the profession. But anyhow, it's of course it's important for any doctor. So let's start about financial independence. And fire. So have you heard of fire? So fire is a very buzzword, particularly in the tech community and particularly in the cities like Bangalore, Chennai. So people after finishing their BE or MBA, so they want to start earning very quickly, maybe in the early 20s, and within some 10 years they want to save adequate money and they retire from their profession, so and settle somewhere in a pleasant place, maybe like a hill station or something like that, have adequate assets for their entire life and retire early. So that's the concept of financial independence and retire early. So, as you are talking about financial independence for doctors, so what do you think about FIRE? My view is that mostly doctors don't want to retire. Okay, so I have seen my seniors and people in my generation also. So, for our profession is sort of by the time we complete your course, it's already too late. So you may be starting earning in our mid 30s or something like that if you are a specialist. And we have put a lot of time in our training, and we love our profession very much. Okay, so it gives whoever you are by the time you become a doctor, uh, you fit into your society, and you get a significant amount of respect. So there may be some, of course, there are some negatives associated with that. There are a lot of difficulties in the profession also, I agree, but there is definitely some amount of respect still. So maybe times, people say that times are changing, but still I feel that doctors are respected, and we love the profession, and that reflects in the fact that most doctors never want to retire. And it's not just about money. More than that, we don't they they can't retire to be honest. So they love to work. So as far as doctors are concerned, my opinion is that fire doesn't matter, because there is no retire early. So the concept is only FI. There is no FIRE. FI, financial independence, because financial independence matters for doctors, because for it matters for anyone. So my opinion is that as a doctor, when you start your profession, you may have a 10-year horizon, and within that 10 years you should earn adequate money, and by that time you should be 10 years you should be financially independent. You may not retire, but you should be financially independent. So what's that magical amount that makes you financially independent? Most experts in the field of finance agree that in India 15 crores should be good enough. Most experts, they agree. 15 crores of liquid asset, savings, I say, cash in hand, maybe your bank balance, maybe some liquid asset like gold, liquefiable asset like gold, and equities, mutual funds, things like that. So you cannot include the house in which you reside in this asset. So that should not be used to calculate that, and definitely not your car. So this depreciation associated, and moreover, by the time you have the 15 crore, you should not be having any EMI to pay. So no debt and 15 crore of liquid asset. That should be enough for financial independence. It may seem like a moderate number, but to be honest, in India, that's a good number, and that should be enough. So you should strive to achieve this number within 10 years of our practice. That's the advice I want to give. Okay. Right. So let's assume that you have started your career. So you have just started your career, the first year of your practice, and let's consider this financial independence as your destination. Okay, so from Tanjore you are going to Chennai. Chennai is the destination. So let's assume that Chennai is the financial independence. Tanjore is the starting point. So what's the most important thing when you start your car for towards your destination? That's a seat belt, isn't it? So the most important is not the power of your car, the speed with which you go. It's mostly this seat belt is the most important thing when you, by the time you ignite your car. Okay, so the seat belt of your financial journey, according to me, is term insurance and health insurance. So before thinking about what you are going to earn every month and at what age you will be earning that 15 crore, all that, the most important thing is put your term insurance and health insurance. Okay, that's the seat belt to start your financial journey. So I'm not going to dwell too much about all these things. So the term insurance should be an amount which really matters. That's the entire point is, if you are, particularly if you are a single earning member of a family and you are married and you have a kid, then the term insurance, the amount you put for term insurance should be, in case something happens to you, the family should be taken care of by that amount. So I don't want to fix a number to that. Okay. And similarly, health insurance. Health insurance is not about doing some simple procedures, getting admitted for 3 or 4 days and handling those charges. That you can handle yourself. Health insurance is about what happens when there is a polytrauma or some life-threatening illness, and you have to spend money in not in lakhs, maybe 50 lakhs, 1 crore, something like that. So that's what you have to consider when you put your health insurance. Okay. Particularly if you are a doctor, because a lot of elective surgeries or simple things, you can manage it yourself. Okay, most of the time your friends will take care. Most of the time you don't even spend for that, not significant amount on that. Okay, because you will be having people, friends you can help. So of course I am this entire topic is as a doctor to doctor, so I am focusing on about doctors. I am not talking about the others. Of course everybody needs financial independence, but this topic is about doctors. So seatbelt of financial journey is over term insurance, health insurance. I don't want to fix the number, decide it for yourself, but it should be a relevant amount, not just a formality. Okay, so and then after this basic things, you consider your insurance versus investment. So these two are insurances. Now you think about investment. So never confuse between the two. So when you take your medical health insurance and term insurance, do not consider them as investments. That number is like, it's like putting those numbers there, monthly premiums for that. And the best thing that can happen is you never claim a health insurance and you never claim your term insurance. Okay, this number is like just something like putting it in some temple or a church, so as a donation. Okay, so the best thing that can happen is you never have a situation to claim that. So next comes the investment. So when it comes to investments, you can talk tons and tons of it, but just I want to share it into divide into 4 things. First, invest in yourself. Of course, you are the person who are going to earn for the rest of your life. So invest in yourselves, make yourself capable of earning more. That's very important, because only if you earn, you can invest in other things. Okay, so and for example, in my early phase of my career, I put a huge amount in buying a portable ultrasound echocardiogram for me. Okay, so that helped me a lot in my anesthesia practice and critical care practice. Huge amount. Huge amount at that time, because it was somewhere around 10 lakhs. 10 lakhs was too big, because at that time I was driving my Maruti Alto, that too by EMI. So 10 lakhs, putting some 10 lakhs on some equipment was a big, uh, I won't say risk, big commitment for me, but I did that and it paid off definitely. Okay, so sometimes it's not just about money also, but anyway, even monetarily it paid well. Okay, so let's go to the next thing. So apart from investing on yourself, I consider real estate as a good investment. Of course, real estate, by real estate I mean only land, empty land, not a flat or not a building, not a real, not a commercialized, nothing. So okay, but anyhow, it's debatable, but according to me it's only land. That's the only thing which doesn't depreciates. Okay, everything else will depreciate. And of course gold is a storage of value. It's time tested, history has tested gold for several centuries, and it's the definite store of value, and it won't go down. Okay, so you should put some amount in real estate and gold whenever possible, and there is no doubt about that. Of course you can debate at the end of the discussion, at the end of my presentation. And the next thing is equity, share market. So that's my favorite part, because that's where I put most of my investments, and I am reasonably successful in equity investment. So most of the subsequent talks will be about equity. It doesn't mean that that's the only investment, but that's because I am quite successful in that, and I want to share that knowledge to you so that you may be benefited. Okay, so and of course first, what are the limitations of the first thing is invest in yourself, isn't it? What are the limitations? Okay, it's going to be difficult. So have you ever heard about something called diamond water value paradox, the paradox of value? So that's a concept designed by Adam Smith in his book Inquiry into the Wealth of the Nations. So he's a pro-capitalist free market economist, and his views are well respected, and of course they shape today's world. He strongly advises free market capitalism, no interference from the government. And there is one problem with that. He himself has explained that. That's called as you can just look at the term diamond water value paradox. What it means is that water, which is very essential for life, to such an extent that you cannot live without water, you will die without water, but water is almost free, or even if it's you pay for it, it's very cheap. It's a very cheap commodity, water. Okay, but it sustains life. Without water you will die. So your life matters very less, don't you see? But diamond, it's a useless commodity. Okay, so it's just a vanity thing. You can live without diamond. The point is you cannot live without water. Without water you will die, but without diamond you are not going to die. Even without diamond the world can live. Every person, every human being can live. So in that aspect diamond is a useless commodity. Just for its storage value and for its beauty and vanity aspect, it is priced high. Water, which is essential, is very cheap, but diamond, which is not essential, is priced high. So it is an inevitable consequence of free market capitalism, because all the most essential commodities, due to competitions, not just competition, there are several aspects to it, it will be democratized, and over a period of time it will be available for free. So a typical example is, think about our farmers. Food is the most essential commodity, essential for life, but it's very rare to see a rich farmer. Okay, so my point is that so not just farmers, think about soldiers, think about teachers, particularly think about the teachers who are I know teachers who are working in some private schools, earning somewhere around 10,000 per month. Okay, they have studied masters. They completed the masters, just earning 10,000. So essential. Essential services will become cheap. There are a lot of economics and politics behind that, but that's not our point. My point is that doctor profession is also going to go towards that. I have a strong belief in that. And the first specialty which is going to die is radiology. Okay, so whatever, so there are several reasons behind that, but just understand this diamond water value paradox. So in my own experience during the COVID time, when everyone is afraid of for their life, that's the first situation where I feel that in spite of being in a very noble and very useful profession, I haven't saved enough money in case something happens to me in that pandemic. So that's where I want to uh, say a little bit about diamond order paradox. If you don't get that concept, just remember that always essential professions will be paid less, while unessential professions will be paid higher, even on a hour to hour basis. Typical example, maybe just look at the entertainment field. So cine stars, movie stars will be paid high, but that's not an essential profession. You can live without movies, but you cannot live without hospitals. Okay, there's no point in having any hatred towards that. That's evolution to some extent. That's what's going to happen. That's how the world goes. So just accept it and try to survive in spite of these odds. Okay, so that's diamond water paradox for you folks. Okay, so this is the paradox of value. You can study that, it will be interesting context. So it's Adam Smith who described it for the first time. So Adam Smith, that's a very good book. You have to study the wealth of the nations if you want to invest in share market. So okay, so as I said, non-essential professions will always be paid high. They will gain more money, and it is a democratic process. So nobody is cheating others. So you have to accept that. So that's the net worth account. But our point is, so what can you do about that? So you can't change your profession. You can't compete. You can just so what's practical is you can invest and try to beat the odds. So has someone beaten Shah Rukh Khan's net worth? So this guy has beaten that. So Rakesh Jhunjhunwala, a very humble auditor, so 20-30 years ago he started investing, did wonderful, and so his net worth is 59,000 crores. So even at this point in 2025 his net worth is higher than the world's top, one of the world's top star. Okay, so in terms of net worth, I'm talking in terms of net worth. Okay, so he has beaten that. So if you invest wisely, you can emulate and become Rakesh Jhunjhunwala. It's possible, but of course you cannot emulate and become a Shah Rukh Khan. So you will destroy yourself. Okay, so then what about? So our idea is now fixed to you have to invest. So that's the only way to gain a significant amount of money. Of course your profession matters, but beyond that significant amount comes only by investing. So we have narrowed down into 3 assets: gold, real estate and share market. Which is the best in terms of returns? So as I said, I am biased towards share market, but anyhow, for comparison I have chosen this one. So what's the price in 2005, what is the price after 20 years, that is now, and what is the growth? So what happens to gold? So gold is now in 2005 gold was 700 rupees. Now it is 12,000 rupees, you know that. So the growth is 17 times. Okay, so this price I have checked in 2 or 3 sources, so it is very accurate. Don't worry about that. So in 2005 it was 700 rupees. Now it is 12,000. It has grown 17,000. For real estate, I have chose one very well performed real estate in Tanjavur. So the most well performed real estate in Tanjavur is around the new bus stand. For the past 20 years, before 20 years, new bus stand, there was just talks about new bus stand coming there, and so at that time it was very cheap. So now it has gone very high. So what happened? So in when it comes to real estate, in 2005, a plot around new bus stand, Tanjavur new bus stand. It was so well, 2 plots actually. It's a cost of 2 plots, 10 lakhs. One of my friend bought it for 10. This is a real value. One of my friends actually bought that, and he sold it recently. So that's why I chose it to give you a example. So demonstrable example. So he bought it for 10 lakhs in 2005. In 2025, he just sold it recently, some 6 months back. So he sold it for 5 crores, and so the growth is 50 times. So a good location, a real estate in good location can beat gold. Okay, so that's what it's saying. Of course, not every real estate will perform like that, but still, no real estate will go down. Okay, so empty lands always appreciates. And next comes share market. So in 2005, the price of Titan is 20 rupees. This is the price around which Rakesh Jhunjhunwala bought. Actually, even before that, he also bought, but like that, 20 rupees was the price in 2005. Now it is 3,500. It is 175 times. So share market beats every other asset class right royally. There is an outright. It wins outright. Okay, so if you pick the right company at the right time, you will win it. So how do you pick the right company in the right time? Or maybe you should you stick to like index funds or mutual funds? So the next slide I will answer that. So let's see that. So this is, as I said, Titan. In 2005, the price is around 20 rupees. Okay, so the price was around 20 rupees, and then it gradually went up. In 2015, in 10 years, the price was around 300 rupees, and now it is around 3,500 rupees. So this is the price chart for your reference. Okay, and so within the share market, should you buy individual stocks or mutual funds or index funds? So Titan grew 175 times. I have shown references. I have shown even the charts. And among the mutual funds, so active fund manager operated mutual funds, Nippon India Growth Mid Cap Fund I have chosen as second because this was one of the best performing mutual fund. So it went 30 times in this 20-year period. Okay, and Nifty index grows 13 times. This is 13 times. This is 30 times. So definitely individual stock picking gives you a very good return, but you should know how to pick that. So for Nifty 50, so that's the index fund. In 2005 it was here. Okay, and now now it is 25,000. So the growth is, as I said, it is 13 times. I will just show the numbers actually. So 13 times the Nifty index fund went 13 times. It was somewhere around 2000 at 2005. Now it is 25,000, 13 times. Okay, fair enough. So definitely individual stock picking matters, because at the same time Titan went 175 times. Okay, remember that. So how will you pick such a stock? So when you want to analyze the finances of the company, to pick a stock you have to analyze the balance sheet and the profit and loss statement. There are a lot of metrics in that. The people will say return on equity, return on capital employed, return on asset, and you should look at EBITDA. Some would say you should look at PAT. But of course I have analyzed. I could read the entire balance sheet. I analyze that. You should learn that. According to me, the best resource for that is Zero Diversity. That's a very good compilation of how to analyze a company. But for practical purposes, these two things will be very useful. In the balance sheet, there is a column called reserves and surplus. This is practically the asset value of that company at that time. Okay, so practically, of course, there are some things to add that, but practically the asset of the company is reflected in reserves and surplus. And the annual profit and loss statement, the earnings per share is the net profit of the company for each share. That's the earning per share. Net profit after tax, after everything. So it's a net profit per share. That's the EPS. Reserves and surplus is the total asset value of that company at that time. So these two are the most important things. You can see whether year on year, just don't look at one particular point and decide. Year on year, what happens to that, you have to see. And CMP is the current market price. So the difference between this and these two is that this is just a perceived value and this is the actual value. What I mean that is that these are real amounts, real values, real amounts. This is perceived value. Perceived value, the price of any share is decided just by the market forces. If Titan is right now 3,500, if a group of people want to buy it at 4,000 rupees, group of people, I say some 1 lakh people suddenly want to buy at 4,000, the price will shoot to 4,000. It's just, yeah, auction. So the price is decided by auction. There is no authority which fixes the price, not the promoters, not the government, nothing. It is a totally democratized free market process. That's why I feel that share market has democratized the private companies and given it to you. That's what I feel. So if you are good in analyzing, you can take part in that. There is no authority which fixes this price. This price is completely democratic. Of course, when there are more stupid people and they inflate the price artificially, you will suffer. But it doesn't matter, because over a period of time, the right price will be achieved, because it's the supply. It's about supply versus demand. When somebody is artificially inflating the price, at some other point it will be overpriced, and at that point people will start selling it, and there will not much buyers to buy at that high price, and it will fall. So that's the point. Just like democracy sometimes does stupid things, but I mean elections sometimes choose stupid people also. Okay, and so, but in long time, democracy is the best form of governance, isn't it? So that's the same thing with market price. Market price is decided by the people, but that's the best thing. And in any field, if there is no one who has the authority, then it is likely that prices will not be manipulated. Even commodities like gold, even forex, there are some authority. Commodity price, the market force can decide the price to some extent, but ultimately every day on day, it is the authorities which fix the price. Even forex, it is the Reserve Bank of India which decides what is the price against the dollar every day in the intermarket in the midnight. But ultimately the future contract sold will try to influence that price, but there is some authority which decides the price. But the beauty of share market is that there is no authority which fixes the price. It is the people which do decide the prices. There are good and bad of it, but anyhow, okay, we can jump to. So the balance sheet and P&L statement. Based on this, how do you analyze the price, and how do you choose the company? How do you pick your Titan for the next years? That's the point. So this is how the price is decided. Okay, during the market highs, if you take the screenshot, so these are the people who are trying to buy the price at these prices. These are the people who, in this amount of people, are trying to sell it at. When the order matches, it will. So it is a continuous process. Price discovery is a continuous process in share market. And okay, so we will come to Titan company, and as I said, there is a column called reserves and surplus. This is the asset this is the total asset value of the company, net asset value. So you can see in 2015, some 10 years before, it was somewhere around 3,000 crores. So the total liquidation value of Titan was 3,000 crores. In 10 years time, now it is 11,000 crores. So it has gradually raised, isn't it? You can see that it has gradually. This can rise only if the company is having profits and if it is reinvesting that. Okay, so it's a good thing. Okay, and and then you see this is the that was the balance sheet. This is the profit and loss statement. So in profit and loss statement, you just neglect other things, look at the earnings per share. In 2015, it was somewhere around 10 rupees, and now it is somewhere around 40 rupees right now. And you can see that earnings per share also, it is gradually increasing. This is post-COVID, there was a fall, but otherwise it is increasing. So earnings per share is, as I said, net profit per share. So now this is this company is earning 10 rupees per share, and at that time the price was somewhere around 300 rupees in 2015. So, okay, so it is earning some 3%, or you can say the price by earning is somewhere around 30. Okay, so earnings per share is increasing, reserves are increasing. So what does that say? So when that increased, the price also climbed from 300 rupees in 2015 to 3500 in 2025. So earning per share increase, reserves and surplus increase, then the price will also increase. So you should see whether this company's current market price, which is a perceived value, decided people can sometimes be stupid, they can overinflate the value, but you should buy only when the price is less, undervalued. Okay, for that you should see the EPS and reserves and surplus. So let's see how this man Rakesh Jhunjhunwala bought this company in 2005, or what price he bought, and how it helped. As I said, in 2015 the market price of Titan was 300. In 2025 it climbed another 10 times, 3500. At the times I showed the graph, I showed the table, it was 10 rupees, it was earning 10 rupees per share. Now it is earning 40 rupees per share. So 10 rupees to 40 rupees, the price, the earnings per share increased, and the reserves of the company was somewhere around 2500 crores at that time. Now it is 11,000 crores. When these increased 4 times, the price has climbed 10 times. Do you see that? So it always happens. So when the company performs well, the price will increase in a much higher way. But if you bought here itself, it's good, but Rakesh Jhunjhunwala did better. So at what price did he buy, and what was the price and reserves at that time? Let's see. He bought it at 20 rupees in 2005, man. Okay, so at that time the earnings per share was 4 rupees. The company was earning 4 rupees per share at that time, and the reserves the company was having was somewhere around 300 crores. So, and even at that time, when he bought, the earnings was 4 rupees and the market price was 20. So he's just bought at the P by E of, see, 20 by 4, it's 5. Or in other terms, in percentage terms, when he bought it at 20 rupees, the company was earning 4 rupees. That is, the company was earning somewhere around 20%. So the company was giving him, like, not like as a dividend. It's capable of giving him 20 rupees for every 100 rupees he spent on the company. So the earnings is, or the return is 20%. I said earning of a return of 3%, 4% itself is good. 5% is beautiful. But when the time he bought, the company was making a 20% returns. So that's why I said he bought it at a very good value. It was undervalued. He saw that the potential is high. He saw that the earning per share will grow brilliantly. He saw that reserves will grow brilliantly. But at that time, the price it was currently earning at 5 times the earnings. 4 into 5, 20, and he bought it. Now see, it is trading at somewhere around 50 times the earnings, isn't it? It is around 80 times the earning. So that always happens. So you should try to buy it at a very good price. So that's how he made his huge fortune. Almost 50-60% of his entire net worth is in Titan for Rakesh Jhunjhunwala. Okay, so now this is another company. So what about another company? This is REC. So I bought this company here, and based on the value I bought this company, can you judge what happened next, or can you judge at what earnings, at what price to earnings I bought it, whether I bought it right? Was this company is going to earnings going to increase further, is going to grow, whether the reserves and surplus will grow? We can see. Okay, so this is the company REC, which I bought. I will show the details. In 2022 I bought it at a price of 100 rupees. In 2022 the price was 100 rupees. You have seen it in the chart. Okay, so the price is around 100 rupees here. So it's around 100. Okay, in 2022. So this is where we bought it. So at that time the earnings per share is around 42 rupees. The company was earning 40 rupees per year, and it is trading only at 100 rupees. Just let it sink. Think about it. So it's very rarely you get when we talk about P by E ratio, we should buy at a low P, something like that. People think that you cannot get a low P by E in these days. Every company has gone to higher levels, something like that. But if you search for it, you will get. Here I am buying a company which has a earnings per share of 40 rupees just for 100 rupees. A P by E just 3, 2 to 3, somewhere around 3, price to earning of 3. Even Rakesh Junjunwala bought Titan at a price to earning around 5. He remember the previous chart. He bought it for 20 rupees when the company was earning 4 rupees per year. Now we are buying this company at 100 rupees when it is earning 40 rupees per year. Okay, so underpriced opportunities exist. We have to search for it. What happened after that? Then the companies, when I bought at this point, I checked previously, the price is also constantly earning. The earnings per share is improving nicely, and after that also it has increased. So what about the balance sheet of the company? In the balance sheet, the reserves and surplus when I bought in 2022 was 49,000. That was also gradually improving, and when I bought in 20 it was around 50,000 rupees, and even after that it is earning now. So what do you think will happen to such a company? So this company is trading around 100 rupees for several years. From here to here, the earnings per share is gradually improving. Okay, so it was at one point it was some 10 rupees, 15 rupees, 20 rupees, 30 rupees. Here it is at this point it is around 40 rupees, but still people are not ready to pay a higher amount. That's why the price is still trading only at around 100 rupees. It's not increasing. And the reserves and surplus was also improving gradually. As I said, reserves and surplus can increase only if the company is making good profit and it is reinvesting those profits. Okay, so reserves and surplus increasing, earnings per share increasing, but the price is not in. That's where I bought it at a very low P by E around 3. So what do you think will happen to such a company after that? At some point it has to break out. So that's what happened. So for 2 years nothing happened, but recently it broke out to higher levels. And of course there is a correction now, and I am buying more. So because even this price is low priced according to me. Okay, so this is how you will find this is a typical value investing. You have to find a good company which is performing well, but still people are not giving a good price for that. Okay, so as I said, the price which the people give is actually just a perceived value. Only the earnings per share and reserves are the true value of the company. Okay, so based on the true value, you find some company which is trading at a very low perceived value and buy that company. That's the point. Okay, it is about in other words, you try to buy a company at a low PE, but it also has a potential for P by E expansion in the future. Okay, that's what we did it here. So this is my holdings. Okay, so from my holdings I just shown this REC. So I bought it around 100 rupees, and now it is around 370. At one point it went to 500, 600, but I didn't sell. I won't sell. Okay, so my idea is not just to book profit. I want to hold it for another 20 years. Okay, so 4,600 shares. This is the buying price, this is the current price, and this is the profits. Okay, so just a summary. So in 2022 we bought it at 100 rupees, and at the time earning per share was 40, and the reserves were 50,000 crores. And in 2025 now the price is 350, earnings per share is 65 per share, and reserves is 75,000. And what do you think will happen in 2032? Some 10 years since our purchase. So the earnings per share trajectory itself shows it is gradually increasing. So we have another 7 years. I think this should at least be 100 rupees. So it cannot be less than 100 rupees. It will be around 100, more than 100, and this will be around maybe 1,25,000 crores. So the market cap, this is practically not the market cap, this is the book value per share. So the book value will go to somewhere around more than 1 lakh crore. And so market price, usually the tendency for people is when the price is not rising, nobody will buy that share. When it starts rising, there will be a rush to buy those stocks. So this will improve tremendously. At one point, the price to earning of at least 20 should be achieved. Most likely 30-40 price to earning P by E will be achieved. So just assume that the earnings per share is 100 at this point. That's the very nominal scenario. Most likely more than 100. Let's say it is 100. And even if the company at that point, the people who are buying the company are ready to give a value it at a price to earning of 20, 100 into 20, this will go to 2000. Even P by E of 10, it will be 1000. So somewhere around 1000 to 2000 at this point is very much possible. Most likely it will be around 2000. So 100 rupees is the purchase price, 2000, so 20 times in 10 years. That's beautiful. So that's how we pick a multi-bagger. Okay. So according to me, this company will, but anyhow, this is just an example. So I'm not going to expose my entire portfolio to you, but this is one of my purchase, and it is paying well so far. And I am, but not every company will just break out immediately after you buy. You have to wait. So some companies you have to wait for a long time. And of course, this is not an advice. Okay, that I will want to say it clearly. At the same time, you should also be careful about, not every company is going in share market is going to, because just because that's a known company, it's not going to go high. Videocon is a very popular name some 10-20 years back, isn't it? At some point, this was the trading price, 400 rupees, 500 rupees, somewhere around 700 rupees in 2008, 700 rupees, and now it is zero. In 2021, it has bankrupt. So if you look at the balance sheet of this company, the fact that it's going to go bankrupt will be very obvious. But still the trading volumes, lot of people are buying and selling this company at 300 rupees. Even in 2012, it's around 200 rupees. 2015, it is again around 150, 200 rupees. People are trading at even at that levels. But by that time, the company is already showing very bad signs. So you should look at those balance sheets. So Videocon, that's profit and loss statement. Even when the people were buying at 200 rupees, the earnings per share has grown. Even in 2015, the earnings per share has gone negative. There is no earnings at all. The last time it's shown some earning is only 2011. Then it is almost a negative. But even then in 2015, when the company has started posting negative earnings, people were buying at around 200 rupees. So that's the madness of the crowds. So not every people analyze properly before investing in share market. But according to me, if you want to invest in share market, invest it wisely, invest in long term, and always do value investing. In value investing, everybody is a winner. Company owner is a winner. You are the winner. When you sell the share in 10 to 20 rupees, the next buyer is also a winner. But when you chase that momentum growth stocks, somebody has to lose at some time. Okay, so that's about Videocon. I showed the profit and loss, and also you can so this is Nykaa is on another hyped IPO. Recently IPO, most of the IPOs are hyped and overvalued, but anyhow, just be careful. That's my opinion. I can't blame on that. If you see the Nykaa's balance sheet and profit and loss statement, a lot of things will be will say that it is overpriced. So Nykaa is a very publicized company, so people look at these publicities and think that this company is worth that value. But the profit and loss statement shows otherwise. For Nykaa, profit and loss, earnings per share, the earnings are almost negative. So only recently they are making some negligible earnings. So it is trading at 250 rupees and it's earning 25 paise per year. So if you put 100 rupees, it will be earning 5 to 10 paise per year. So it's a very, the P by E ratio is somewhere around 300, 400, something like that. So it's obviously overpriced. So I will not touch these stocks, but maybe some people may have justifications for that. The only thing good about this is the sales is increasing exponentially. It's a good thing, but debt fueled growth in sales is not good for any company. At one point they will die. Okay, but anyhow, sometimes at some point, if the margins improve, they may survive. But you don't need to take that risk. That's my opinion. I won't buy this stock. Okay. And so everything we talked also about is about value investing and Warren Buffett. This is Warren Buffett. This is the guru of value investing, he just beaten most of the hedge fund managers in USA. So he has proven that just by looking at the company balance sheet, profit and loss statement, identify good companies, don't worry about the sentiment, just buy undervalued opportunities and stay with that, and you will make good money. That's what he believes, and he is very successful in that. And Rakesh Chunjinwala also did the similar thing with Titan. But at the same time, there is another person. So technically at this point, so far we are talking only about Warren Buffett sort of investing. But from this slide, we are going to talk about the next person. So everyone knows him, Warren Buffett, but not many will know this person. He is Jim Simmons. So Jim Simmons is a very interesting person. He believes that you don't need to look at the company finances. No need to look at profit and loss statement. No need to study the reserves and surplus. No need to study about the sectors, macroeconomics, nothing. He's a pure mathematician. He just look at the price movements. Of course, he looks at the balance sheet. He looks at it just like a data. So based on analyzing a lot of data and mathematically modeling it, he believes that price movements can be predicted. So technically my presentation is over. Okay, so this is, if you are just looking for financial independence, long-term investment, I have talked about a little bit about gold, real estate, and I have talked about long-term equity investing. So that's over. So this is how you should do your long-term investing. Okay, but from this point, from this slide, I want to talk a little about Jim Simmons and his methods. He's a short-term trader. So I am also, in spite of doing a lot of long-term investing in equity, I also do believe in Jim Simmons and his type of mathematical approach towards analyzing short-term movements and making short-term trades. Okay, so if you want to know that, you can continue to listen to the next 3 or 4 slides, or otherwise you can stop here itself and close that. Okay, so now, as I said, from now on we will be talking about Jim Simmons and his methods. Okay, so this is just for I want to share that not every Reliance is one of my huge holdings for long term, but not everything will move up immediately after you buy. And what do you think this chart is about? So this is gold. Okay, and so recently gold went very high, isn't it? So recently it went high. So this is a value of 10 grams of 24K gold, and I am just as I said, I am going to talk about short-term trading. There are a lot of things you have to think when you do short-term trading. Of course, you should time the market right, and you should predict. You should be able to predict the price movement. And as I said, market price movement is more about psychology, and it's a perceived value. It is the mood of the crowd. Fundamentals will work only in the long term. In the short term, it's you should do a lot of chart trading, a lot of data, and look at the price movements. And there are some, I just talk about one method of doing short-term trading, some sort of arbitrage trading. So what I am going to do next is an arbitrage trade. So this is the price of gold future contract, December future contract right now. So it has risen recently, and you know that. And the current spot price of gold is this. So 24K gold, it's 12,416. So and this is the price of gold December future. So this is a spot to future arbitrage. Arbitrage is one type of short-term trading. Okay, so I just, for example, I am not going to talk entirely about all the trading methods. I I do futures contract, I do options contract. In fact, I pledge my entire equity to fund the futures and option trading, and those profits I used to buy long-term equity. So that's how it goes. I'm not going to talk about the entire thing. So based on my short-term prediction that the gold price has to correct recently, I am making this trade. This is the spot price of gold right now, and this is the December future contract. So the agreement what I make is that the future contract with the buyer, I am selling the future contract 12,000 for 12,845 rupees, with the buyer to sell him to 1 gram of gold at 12,845 rupees on 31st December. So that's the price at which it's trading now. So 12,845 rupees is the agreed price at which I have sold my future contract, sold 1 gram of gold, say 1 gram of gold, I have agreed to sell at this price to the buyer. Okay, but the point is that already I have some gold with me, so the underlying asset I am having it with me. So the result of this trading can be, in scenario 1, if gold falls down to 12,000, my profit is 845 because the price agreed is 12,845, and on 31st December if the price goes to 12,000, I will just buy one contract at 12,000 from the free market, from the common market, and sell it to 12,845 to the buyer, because I have already made that agreement. So I buy it at 12,000 and sell it at 12,800. This is called a short selling, isn't it? I have sold already to 12,845 and I can buy it back at 12,000. So 845 is the profit. And in case this gold escalates to 14,000, I won't be losing anything, because I already have the underlying asset. I am having gold with me, and the price of gold today is 12,416. So it has gone to 14,000. So I have, based on my underlying asset, gold which I am having has raised in value, but I have a contract of 12,845 rupees. I have sold at 12,845 rupees, and I have to give it to 14,000. So I will be losing 1,000. Correctly, to be precise, I will be losing in this trade 14,000 minus 12,845. That is around 1,155 rupees will be my loss. But the underlying asset has given me an earning of 1,600 rupees. So I am earning 1,600, but I am losing 1,150. So even in this, so there is no loss. Practically there is no loss for me. To be honest, there is a profit here also. Here also there is a profit. Here also there is a profit. In any scenario, I cannot make a loss. So this is some example of an arbitrage trade, future spot arbitrage. I am just this is among many things Jim Simmons did. This is the most basic, very basic thing. He tracked the price always and made these arbitrage trades. There is some concept called reversion to the mean. So his yearly trade some 30 years back, what he did is mostly commodity price they trend and revert to the mean. Based on that, he took trades like this, what I have explained here. But these are all pretty basic things. He has gone to several advanced level based on his understanding of max statistics and mathematical modeling. He made 65% profit per year. His fund grew at 65% profit per year. So I just want to say that short-term trading can be done without huge speculation and without losing much. It's not like gambling, but using precise mathematics. That's what he did. Okay, anyhow, the methods are too complex to explain. Just to say that I am also doing that, and I'm quite profitable. I will show that. So this is my Twitter page, and so of course I love both these guys, and I have some followers with it. And always in my Twitter page there will be a verified PNL which shows my short-term trades, and most of the time I also share my commitment in long-term equity. Whenever I buy some shares for long-term equity, usually I share them mostly. Okay, so you can always check whether I am profitable in short-term trades. And yeah, this is the recent ones for the past 3 months. And it's available, so you can check it. It is verified by Zerodha, so it's not just a screenshot, it is a verifiable data. And always pay your taxes. That's one advice I will give you. So I paid a very huge tax last year just for my this is just for my investment account from equity investing, okay, not for my profession. For my profession I paid only 4 lakhs tax, but here I am paying somewhere around 30 lakhs tax. See the huge difference. That's what is called diamond water value paradox. Okay. um, so these are some of the vanity metrics. So in Indian Trader League, sometimes I will be I will find my place there. So I am an investor, but at the same time also a reasonably good trader. Okay, so yeah, in there is an app website called Sensible, verified by Sensible. This also tracks successful traders in India. So sometimes I will be there, and so this is the last slide. So I don't want to show the current market price at which these shares are trading. I just want to say that these are some of my long-term commitments, and I am expecting them to perform well over the next 10-20 years. These are based on fundamentals, not short-term trades. These are not short-term trades. These are based on fundamentals. I have analyzed the balance sheet, profit and loss statement for year on year. I am analyzing them, looking at them, and then holding them. These are undervalued right now, and I am expect these things to go up. Anyhow, this I may be wrong. So if I make some 10 investment, even if one or two grows to be a multi-bagger, that's enough. Okay. And of course, I am not a SEBI registered advisor, and I will never become a SEBI registered advisor. So do your own due diligence. These are just my convictions. Okay, not an advice. Definitely not an advice. And so, thank you. And